Welcome back to Investing Talk podcast. Today we're tackling a question lots of you have been asking about a really big name in Southeast Asian tech. Is Grab Holdings a good buy right now? We've gathered the latest financials, look at the charts, check the market mood. Basically, compile everything from our sources to give you a clear picture of where Grab stands. Before we jump in, though, just a quick reminder. If you find this helpful, please hit subscribe, like the video, and drop a comment below. Seriously, if there's another company you want us to look into, let us know in the comments. We're always looking for the next topic.
Yeah, and Grab is, well, it's an interesting one. It's a super app, right? It spent years just growing like crazy. And now it seems to be hitting some important milestones in terms of scale and actually making money. So yeah, we'll break down what the numbers are saying, the technicals, and what really matters for investors at this moment.
Okay, let's unpack that. The core health of Grab. We've definitely seen some big financial shifts lately. Looks like they're finally getting serious about the bottom line. What are the headlines telling us? The trajectory.
The trajectory is improving fast. Revenue still growing strong. Sources show 2024 revenue hit about $2.8 billion. That's up almost, 18.6% year over year. So demand is still there. But the really big story, like you said, is the move towards profit.
Right. That's the metric everyone's laser focused on now. Enough growth at all costs, right?
Yeah.
People want to see real earnings potential. So what are the specifics? How much did those losses actually shrink?
That's where you really see the scale helping them. Now, they're not quite at full GAAP profitability yet. That's the, standard accounting profit. But the net losses, they dropped massively by almost 76%, down to just over $100 million for 2024. That really shows they're getting costs under control and leveraging that huge user base.
Okay, GAAP versus adjusted metrics. That's important. You mentioned adjusted EBITDA turned positive. Maybe quickly explain for our listeners, why is that specific measure such a key step? What are they adjusting out?
That's a great point because it really clarifies the operational health. Adjusted EBITDA. Well, it stands for earnings before interest, taxes, depreciation, and amortization. It basically strips out non-cash stuff like stock compensation and maybe some one-off costs. So when that number turns positive, like it did for Grab in Q2 and Q3 of 2025, it tells you the core business, the day-to-day running of things, is actually generating cash. It proves the model works at scale. And analysts. The consensus now is that for 2025, their net income should be, around break even or maybe even positive. So the trend is definitely heading the right way.
And the financial muscle to back that up, are they well capitalized? Can they handle more expansion, fight off competitors?
Oh, absolutely. The balance sheet looks really robust. As of mid-2025, Grab had something like $5.1 billion in cash and equivalents. Compare that to about $2.4 billion in debt. That difference, that's a pretty comfortable cushion, gives them runaway, flexibility. They're not desperate for cash.
And are they actually generating cash themselves from running the business?
That's the free cash flow question, right?
Critically, yes. They are free cash flow positive over the last 12 months. And FCF, that's the cash left after all the operating costs and investments. It's the real surplus cash that FCF can fund R&D, maybe buybacks down the line, who knows. And their liquidity is strong too, a current ratio of 4.2. That means plenty of short-term assets to cover short-term debts. Very healthy overall.
Okay, so finances looking stronger, trajectory improving. But the big challenge in that region is competition. How do they defend their position? This gets really interesting. Grab is dominant, but what's the sustainable edge against rivals like Gojek?
It really comes down to that super app model and the network effects it creates. It's powerful. Grab holds the top spot, or close to it, in ride-hailing and delivery across major markets. Think Singapore, Malaysia, Vietnam, Indonesia.
And it's the way they tie it all together that keeps people hooked, isn't it? Like if I use Grab for my ride, maybe I'll just have a button for lunch delivery later or use their wallet.
Precisely. That integrated platform rides, food, groceries, even digital banking, it creates really high stickiness. The beauty of it is the cross-selling. Getting that first user might be expensive, but selling them a second or third service, much cheaper. That's a structural advantage that's tough for, say, a standalone delivery app to match.
But is there a risk of spreading too thin, adding too many features, maybe hurting the core experience or just burning cash on things that don't add much value? We've seen other super apps stumble there.
That's a fair point. And yeah, it's a risk they need to manage. But it seems like their focus now is smart. They're pushing into the areas with potentially higher margins. And right now that means fintech. That's really seen as the key growth engine, the thing that could justify a higher valuation long term.
Tell me more about fintech. How does financial services, which sound expensive to set up, become the high margin play?
Well, it diversifies them away from just taking a small cut of competitive ride or delivery fares, right? So pushing into digital financial services, digital ads, that widens the moat. They're partnering up with banks and e-wallet providers too. That lets them offer things like loans or insurance using their massive user data, but maybe without taking on all the regulatory headaches themselves. It's about leveraging what they already have, the users and the data.
And has this strategy shown up in recent results? Did it make a difference last quarter?
Yeah, the momentum looks pretty strong, actually. Q2 and Q3 earnings for 2025 both beat what analysts expected, and that was largely driven by better than expected profits in delivery and mobility. Suggests they have some pricing power, maybe getting more efficient. Q2 specifically saw revenue jump 23% year over year to $819 million, and that adjusted EBITDA hit $109 million. And importantly, that was the 14th quarter in a row of adjusted EBITDA growth. So there's consistency there in improving the core operations.
Okay, let's pivot a bit. Fundamentals sound promising, but what about the stock itself? The technicals, the market sentiment? Is the market buying this story? What are the charts and the analysts telling us?
Well, the technical picture actually seems to back up the fundamental story pretty well. Grab shares, they've carved out a pretty clear bullish trend recently. You're seeing higher highs and higher lows over the last 3 months or so. That's sort of textbook uptrend behavior.
But can you put some numbers on that? Where are the key levels traders are watching?
Sure. The stock came up from a 52-week low around $3.36, climbed to a recent high near $6.62. Right now, it's trading around $5.64. Key support, where buyers seem to step in, looks pretty tight, maybe $5.40 to $5.50. And resistance, the ceiling they need to break through that, seems to be between $6.60 and $7. If it can decisively break above $7, well, that could open the door for a bigger move higher.
And the technical indicators, are they flashing green too, or is it just price action?
No, they're looking supportive. The price is above both its 50-day moving average, which is around $5.61. That's kind of short-term trend. And it's also above the 200-day average, around $4.96, which is more the long-term trend indicator. Being above both is generally seen as bullish. Plus, the MCD indicator, which tracks momentum, it had a bullish crossover back in October. Suggests buying pressure is building. And volatility, it's actually moderate, around 5.7%. That suggests this isn't some wild speculative spike, but maybe more orderly buying. Accumulation.
So you've got improving financials, positive technicals. What's the overall market conviction? Are the big institutions buying in? What's the analyst consensus?
Sentiment seems overwhelmingly positive, actually. The consensus rating from analysts is a buy. Looking at the sources, out of 12 analysts covering it, 7 have a buy or overweight rating. And importantly, 0 recent sell recommendations. That's pretty strong backing from the pros.
And where do they see the price going? What are the targets?
The average 12-month target falls somewhere between $6.04 and $6.63. So that suggests, maybe 7% to 20% upside from where it is now. The highest target out there is $8. We're also seeing data from September showing strong institutional inflows, meaning the big money managers, the funds, seem to be accumulating shares. And even checking retail investor forums, the mood seems pretty positive, mostly focused on that fintech growth story. So belief seems fairly widespread.
Okay, looking ahead then. Investors always want to know about catalysts. What could potentially move the stock in the near term, say the next 3 months?
Yeah, there are a few key things on the horizon. First up, the Q3 2025 earnings report. That's expected around November 10th or 11th. Given the track record, the market's probably expecting another solid quarter. And if they deliver another upside surprise, well, that's historically triggered sharp moves up in the stock.
Any speculative buzz? Rumors or potential deals that could excite the market, that always gets tech stocks moving.
There's definitely some chatter, yeah. Nothing confirmed, obviously, but you hear things on forums talk about a potential fintech acquisition, maybe strengthening their position there, and also some buzz about ongoing partnership talks with a major global payments company. Again, just rumors. But if something like that were announced, that could cause a pretty significant re-rating of the stock, signals wider ambition. Plus, management is expected to give updates on maybe new country launches or fintech product rollouts before the end of the year. That could be a solid operational catalyst, too.
All right, so lots of potential positives, but let's balance that. What are the main risks investors need to keep front of mind? No stock is risk-free, especially in that dynamic part of the world.
That's crucial, right? While the momentum looks good, there are definitely risks. Regulatory and competitive are probably the big ones. On the company side, remember, they're still not guaranteed full-year GAAP profitable yet, even with the improvements. Need to keep watching that cash burn until they cross that line definitively.
And operating across so many different Southeast Asian countries.
Yeah.
That must bring headaches, right? Regulatory risks.
Absolutely. You're dealing with multiple governments, multiple sets of rules, laws around drivers, gig workers, like we've seen debated in places like Vietnam or Indonesia. They can change. And if they do, Grab might have to adjust its pricing or spend more on compliance or benefits. That can hit margins pretty quickly. It's a complex landscape.
And finally, competition. You mentioned Gojek Goto. Even if Grab is leading, that rivalry must still be intense.
It's a constant pressure, yeah. Aggressive competition is just a fact of life in that market. If Gojek Oto or another player decides to get aggressive with subsidies again to try and claw back market share, well, that could force Grab to respond, spend more, and potentially impact that nice profitability trend they've established. It keeps them on their toes. So, look, pulling it all together, you've got strong revenue growth, that really important shift to positive free cash flow, clear market leadership thanks to the super app model, and technicals that look pretty supportive right now. It paints a fairly clear picture based on the analysis we've seen. The overall rating our sources assign is bullish, sort of an 8.5 out of 10. Seems attractive for both maybe shorter-term traders playing this earnings cycle and for long-term investors who want exposure to that structural Asian tech growth story.
Right. So for you, the listener, the key takeaway here seems to be that fundamental shift. Grab isn't just about chasing growth at any cost anymore. They seem focused on scaled profitability now, and they've got a much stronger balance sheet backing that up. The foundation looks, well, a lot more solid than it did maybe a year or two ago. Okay, let's end with a final thought for you to consider. Grab recently raised $1.5 billion through zero-coupon convertible notes, basically, interest-free debt that can turn into stock later. How should they best use that big chunk of strategic capital? Should they go hard on M&A, maybe buy a fintech company to really cement their lead? Or maybe use it for share buybacks to boost the stock price now? Or just pour it all into rolling out those fintech products even faster across the region? What move maximizes value over the next couple of years? Something to think about. Thank you for joining us for this look at Grab Holdings. We hope this analysis helps you stay informed.